Okay, let's unpack this. Imagine like making a really simple math error on your tax return, right? And then a year later, the government turns around and demands a mandatory 5,000 rupee fee just for the privilege of fixing your own typo.
Yeah, it's pretty wild. I mean, welcome to the new era of tax filing.
Precisely. So if you're joining us today, welcome to a new deep dive. We are looking at the Central Board of Direct Taxes, or the CBDT updates for assessment year 2026-27, which is financial year 2025-26.
Right. And, on the surface, a document titled Issues in ITR Forms sounds like basically a cure for insomnia.
Total snooze fest.
Exactly. It sounds like nothing but moving digital boxes around on a screen. But what we actually have in front of us today is this really fascinating treasure map of the government's entire digital enforcement strategy.
Yeah, the goal of today's deep dive is to decode exactly what these tweaks mean, because it isn't just admin stuff. These changes show how the government is, like, seriously tightening its digital net.
Oh, absolutely. They are finding behavioral loopholes and, surprisingly, in some places, completely rewiring things to cut out red tape.
Which is nice for once.
Right. But the core of it is improving transparency and strengthening data validation. For you listening, understanding the mechanics of these forms right now is honestly the ultimate cheat code.
Yeah, to avoid those automated mismatches and getting trapped in an endless loop of tax notices down the line. So let's start with what everyone cares about most: time and money.
The clock and the coin. It's a logical starting point.
Exactly. Let's look at the deadlines first, because there's a big shift in August, right?
Yeah, so for a specific subset of taxpayers, mostly those in business or a profession who don't require a formal tax audit, and also partners in non-audit firms.
Okay, so a lot of small businesses.
Right. For them, the filing deadline in the ITR 3 form has been permanently extended. It moved from the usual July 31st rush to August 31st.
Okay, that's actually huge. That gives people some vital breathing room.
It really does. But here is where it gets interesting regarding how the system handles mistakes after that deadline. The rules around revised returns have been overhauled.
Because you used to get 9 months to file a revised return, right?
Yeah, but now you actually get a full 12 months.
Right, they gave us more time.
They did. But, and this ties back to that fee you mentioned at the start, it comes with a literal price tag. Under Section 234I, there is a new fee column.
Ah, there's the catch.
Exactly. If your total income is under 5 lakh rupees, fixing your mistake costs you 1,000 rupees.
And if it's over 5 lakh?
Then it's a flat 5,000 rupees, non-negotiable.
Wow. It's like the library giving you an extra 3 months to return a lost book, but making you pay a massive late fee for the privilege.
That is a perfect way to look at it. It's basic behavioral economics. By extending the deadline but adding that financial friction, the department is giving taxpayers a safety net for genuine mistakes.
But they're punishing you if you abuse it.
Precisely. They are actively discouraging sloppy, rush initial filings. People used to just throw numbers at the wall at 11:59 p.m. to beat the buzzer.
Right, just to get the receipt and fix it later, so now you're paying for that lack of precision. Which, honestly, leads right into our next big theme, the show your receipts era.
Oh, this is where the algorithmic power really shows up. If the government is giving you more time, they are demanding absolute proof for your claims.
Yeah, starting with this basic contact info, the new forms require both a primary and a newly introduced secondary address, plus primary and secondary emails and phone numbers.
Which is basically them engineering a system where you can never claim you missed a legal notice.
Yeah, right. But the deductions, that's where the net gets really tight. Let's talk about political donations under Schedule 80 GGC.
So, historically, taxpayers filing ITR 1 through 6 could just declare a contribution amount.
Which was totally based on the honor system, let's be real.
Basically, yeah. But now, you can't just put a number. You must provide the exact name and the PAN, the permanent account number of the political party.
And charitable donations are even stricter. Under Schedule 80G, the portal now requires the exact transaction reference number, like your UPI ID or check number.
Yep, and the IFSC code of the bank that processed the payment.
Is this the end of the casual deduction? Because, I have to wonder if people used to just guess how much they gave to charity, and the government finally cracked down on inflated claims.
Well, this raises an important question about digital traceability. It's a brilliant move to eliminate ghost donations.
Ghost donations?
Yeah, people rounding up from memory, or even syndicates generating fake receipts. By forcing you to link a specific UPI reference in PAN, the system's APIs can instantly cross-reference your claim with the charity's bank
Oh,
records.
wow. So there's no human auditor manually checking a paper receipt anymore.
Exactly. It just automatically denies the claim if the digital strings don't match perfectly.
That is intense. And you were saying this intense traceability isn't just for charities, it's being heavily weaponized in the business sector, too.
Oh, absolutely. The business engine is where they are really flexing this tech, specifically to protect vulnerable vendors and track volatile income.
Right, like with F&O trading futures and options, retail day trading has exploded, but reporting it is super messy.
It's a nightmare because a trader making hundreds of microtransactions generates this massive turnover that looks like a huge corporation, even if they only make 50 bucks.
Yeah, and mixing that with regular business income just triggers audits left and right. But here's where it gets really interesting. In Part A of the P&L, F&O trading gets its own dedicated fields now.
Yes, 12C for turnover and 12 for income,
It's like giving a specific labeled shelf in the fridge to a messy roommate. It keeps F&O turnover from spilling into and contaminating regular business income data.
which totally prevents those annoying broker mismatches. It gives the algorithm a clean data set to match against what the stockbrokers report.
Such a smart fix, but the MSME change, this one blew my mind.
Oh, the MSME interest disallowance is probably the most profound update in the entire document.
Let's walk the listener through this. So, under Section 16 of the MSME Act, if a big company delays payment to a micro, small, or medium enterprise, they get penalized, right?
Right. They have to pay compound interest at 3 times the RBI bank rate. It's meant to stop conglomerates from using small vendors as free credit.
Because late payments literally destroy small businesses. But that penalty used to be a civil issue between the companies. Now, ITR Forms 3, 5, and 6 have a new column specifically to disallow these interest payments as a tax deduction.
Yeah, and that is huge. The CBDT is using the tax form as a strict enforcement mechanism for an entirely separate law, the MSME Act.
So big businesses are being forced to basically audit their own payable timelines?
Exactly. If they pay small vendors late, they face a double financial hit. They have to pay that exorbitant interest to the vendor, and they don't get any tax break for it.
It's wild that the tax form is acting as a corporate regulator, and they're doing something similar with partnerships, right?
Yeah. Yep. Schedule IF now requires the exact amount of interest and remuneration due or received from partnership firms. It wants a granular breakdown to ensure the partner's personal declaration perfectly mirrors the firm's corporate filing.
It's just a complex web of niche tracking. Even the simplified tax schemes are getting new guardrails.
Right, like the presumptive taxation schemes.
Yeah, let's look at point 10 from the sources. Taxpayers on the easy mode presumptive scheme using ITR 4 now have to explicitly disclose their investments under financial particulars of the business.
Which seems counterintuitive at first glance.
Right. Wait, presumptive tax was designed so small businesses didn't have to maintain exhaustive books. Why is the government suddenly demanding to know about their investments?
Well, if we connect this to the bigger picture, it makes total sense. It's basically a stealth wealth check.
A stealth wealth check.
Yeah, think about it. If a taxpayer declares very low income using the presumptive scheme, but simultaneously discloses massive capital investments, like buying a 50 lakh machine, the system knows something is wrong.
Ah, the math falls apart. The algorithm instantly flags the mismatch for investigation. Where did the money come from?
Exactly. It weeds out bad actors without forcing honest small businesses to undergo full audits. And we see similar logic with interest income now.
Right, in Schedule OS for other sources, you have to specifically report interest from NBFC's non-banking financial companies versus regular bank interest.
And furthermore, there's a new column to capture interest income taxable at a concessional 9% rate.
That's from foreign currency or rupee bonds under Section 194 LC, right?
Yes. By isolating that 9% rate, the backend can automatically match your claim against the specific TDS certificates uploaded by the infrastructure company.
It's all about that closed-loop API matching, which brings us to the non-resident tech companies, points 11 and 17.
Right, the new Section 44 BBD scheme, it deems a 25% profit for foreign entities setting up electronics manufacturing in India.
And what's wild is how the physical layout of the form clarifies the law. They placed Section 44 BBD directly within the no account case reporting section.
Yeah, placing it alongside older presumptive laws signals the government's intent to extend the audit exemption to these tech firms. The form itself acts as a legal interpreter.
That is fascinating. But I know for a lot of people, all these new columns and tracking mechanisms sound exhausting.
It does sound like a lot of extra work.
But there's a silver lining here. To make room for this new data, the tax department actually did a lot of spring cleaning. They eliminated a ton of redundancies.
They really did. And in a mature digital ecosystem, redundancy is the enemy of automated processing.
So what did they take away? Let's start with the auditor details.
This is a great example. Previously, you had to provide a massive list of auditor info, membership numbers, firm registration, all of it. Now it's slashed down to just 4 things.
Data furnishing, acknowledgement number, name, and PAN, right?
Exactly, because the PAN is the master key. The system can just pull the rest of the data silently from the Chartered Accountant's registry.
That is so much easier. And they also removed that awful capital gains bifurcation.
Oh, thankfully, last year, taxpayers had to split capital gains pre- and post-July 23, 2024 because of a mid-year rate change.
Such a transitional headache.
Totally. But that mid-year headache is entirely gone for AY 2026-27. It streamlines the schedule beautifully.
They also trimmed the representative assessee section down to just 3 details: name, email, and contact. And what about the buyback shift?
Right. Schedule BBS in ITR 6 has been completely removed.
Because the tax burden on share buybacks shifted from the company to the shareholders as of October 1st, 2024. Right?
Yes. The corporate entity isn't paying that specific tax anymore, making the schedule obsolete. So they just scrapped it.
And they also removed foreign retirement accounts from ITR 1 and ITR 4.
Which is pure logic.
Yeah.
Taxpayers with foreign assets aren't legally allowed to use those simplified forms anyway. So removing the fields stops people from accidentally invalidating their own returns.
It's a structural trap they finally removed.
Exactly. It shows the system is becoming highly targeted rather than just randomly fishing for information.
So what does this all mean? The government isn't just making forms longer to torture people. They are actively removing friction where data is redundant.
It's a trade-off. They demand higher precision for things like MSME payments and donations, but they offer a cleaner, faster digital experience overall.
We've covered a lot of ground today, from the new August 31st deadlines and the revised return late fees to the API tracking of charitable donations and F&O trading.
And don't forget the MSME enforcement and their presumptive tax wealth checks.
Yes, all of it points to a much more rigorous but cleaner digital system.
It really makes you think about where this is all heading. We saw today how the tax department is using ITR forms to enforce the MSME Act for vendor payments.
Right.
As data integration gets stronger, will future tax forms become the ultimate dashboard for enforcing all civic and corporate laws?
Oh, wow. Like what?
Well, could your tax forms soon police your company's carbon footprint or diversity metrics or labor practices just by algorithmically denying tax deductions for bad behavior?
That is a wild thought. The tax form becoming the ultimate enforcer of societal standards. Definitely something for you to mull over as we wrap up today's deep dive.
It's a changing world, that's for sure.
It really is. Thank you for joining us on this deep dive. Remember, staying informed on the mechanics behind these forms is the absolute best way to stay ahead of the curve. See you next time.